Welcome back. So oil prices have topped $100 now, and lots of people are concerned that the Middle East conflict, when it escalates, could lead to a lot of problems for our economy. Senyo Hosi is joining us, formerly CEO of the Seaboard, now an energy sector analyst. Senyo, thanks for joining us. So we heard the news. Oil has crossed $100 a barrel, the highest since 2022. How concerned should we be looking at the way the conflict is going in the Middle East?
Well, the key problem with oil is its large impact on inflation and actually the cost of living, simply put. Inflation, you look at the entire CPI, you look at the wage, transport is accounting for about 10.5 thereabout of that particular scale. So it's a significant portion of it. It has implications on electricity, our gas prices will be affected. So you're expecting to see a significant shift that's everyone should be worried about. Again, largely driven by the war. There's a good volume of products coming from that particular part of the world that seems to be stranded as a result of the war. About 20% of our global supply seems quite stranded. There are a few trying to pass through, but largely it is stranded. And that has created this immediate effect of a price hike. So yes, we should be concerned as consumers, but as a country that also produces crude, it's important that to the extent that we can, it's also not that simple for it to just ramp up production. Or ramping up production comes with a number of planned activities and investments. So it may take time for us to even take advantage of it. But our income from crude too is expected to go higher than currently estimated. I think in the budget, I guess we have an estimate of about 63, 65, thereabout, and now see where we are, above 100. I've just been notified that we are just hitting below 100 now, about 99 now, but still just around 100, much better than what was budgeted for. So that's where it compensates.
Earlier today, Goil and Star Oil announced fuel shortages over ECUM's port challenges. Now, there have been denials back and forth.
About what?
Over port challenges of the ECUMs, which is the system that...
ICOMS,
yes. Some people feel like there's more to this than port issues, that maybe we're already feeling the effect of shortage, because in some parts of the world, they're already having shortages. I'm told Australia and other parts of the world, they're having shortages because a lot of their oil comes from the straits you referred to. From what you know about the sector, how concerned should we be about the potential of a full-blown fuel shortage?
For us in Ghana, I don't think that there's so much to be alarmed about. I'll discuss the BDC and OMC situation. Our supplies come from anywhere in the world, but our main trade routes actually come from Europe and the US Gulf. So that particular part of the world, we'll call it the Arab Gulf, supplies, and countries that may be affected significantly by that will be more of our southern neighbors than those of us in West Africa. Thankfully, we produce crude. Nigeria produces crude. Dangote's humongous refineries there to support supply for the region. Europe is also still not closed out to us. The US Gulf is there. It's also ramping up its production. The US doesn't want a very high crude price. Of course, they don't want Russia to make too much money. They also still want to incentivize production. So they're also trying together with OPEC to also increase a bit of the crude supplies for the world. Australia will feel what it is feeling, largely because it is significantly dependent on the Arab Gulf. We are not, so we don't have that immediate risk yet.
Some people feel like maybe these announcements by the two leading OMCs could be a pretext for
some... the two institutions. So let me just delve into the OMC and BDC situation.
Yes.
We don't have a BDC and OMC shortage situation as a result of the global supply challenge. No. It is a pure price matter. It's a pure price matter for the most part, and also a financial matter. And I would explain. The data today, if you look at the pricing window in which we are, if you wait and you want to sell one of our products, I won't say which deliberately, and you sell them in the next window, which will start on the 15th of this month.
Of
How many
March,
days more?
16th of March, yes.
6 days more.
15th
You make a 46% increase in your ex-ref return. So there's a certain financial incentive for people to hold back their stocks right now. And it's not just BDCs, it's also OMCs. OMCs today are in a hurry to buy a lot of product from BDCs today so that they can sell it rather in the future and buy it at a cheaper price today and rather move that benefit to themselves. So it's an internal battle between two of the key sectors here, trying to see who want to make the most of the opportunity that this particular price hike presents to the market. And again, it's not everybody that is in that mix. There are a number of people who don't have the opportunity because they are not sitting on old stock. They are still going to have to deal with stocks that have been priced against this 15th that I'm saying. So they cannot get the advantage of this 46%. In another product case, it's a 17% increase in return. So people are just trying to take advantage of it. You should also realize that these are businessmen. They have also suffered in some past weeks where they've lost money, all right, as a result of certain market shifts and competition locally. So some of them are seeing this as an opportunity to recover that.
Okay.
I will walk you a bit through this process. For us to fix the prices for the 15th to the 31st of March, we'll be looking at the world market prices from the 27th of February all through to the 11th of March. And you see, that is where this price hike is sitting today. That's where you have it. Now, the products today, which is from the 1st of March all the way to the 15th of March. So sorry, when I said 15th to 31st, supposed to be 16th to 31st. So for the 1st to the 15th of March, the price that is applicable in this particular window is the average world market prices that we had from the 12th of February to the 27th of February, which does not benefit too much from the
conflict,
the situation, the price hike that you see.
Okay.
So those who end up buying in that window, but will be selling it against the next window, will make huge profits. So that's exactly
finally, what are the strategic choices Ghana has to make now to protect itself against an escalation of the conflict leading to a potential global disruption? What do we need to be doing yesterday in order not to get into serious challenges?
I think immediately we have to close out on our G2G solutions, especially on the crude side. We already have two of our refineries working. Senyo is working. Largely, Tor has also found its way up. So we don't really get into the battle of the products. The crude, which is the base product, can actually give us a lot more security. We produce far, but let's see Big Brother Nigeria and see if that's going to be such unique allocations made on a G2G basis, still paid for by the private sector, so that we can assure supply. But this also raises one thing. Our regulators would have to relook the systems for monitoring our ensuring supply for the sector. You see, a number of BDCs even have products, but they are under what you call financial hold. It's some form of lien. You have not fully paid the supplier, or the credit that's been given you is a bit structured and limited. If you go today, some BDCs have that situation, so they can't actually release cargo onto the market. You also have a situation where people don't, but they'll be using this financial hold as an excuse. But there's technology that I know that the MP is working on that can give them thorough visibility so that they can actually promote or protect consumers as far as supply is concerned. So we encourage them to expedite those solutions and have better control on supply assurance for us as a country. But there's no need to fret. We don't have a situation where we are going to have shortages today or tomorrow. All that you see today is just people trying to optimize market opportunities that have been presented today.
That's a mighty relief to hear from you. Senyo, thank you so much for your insights as ever. on this very exciting topic that keeps updating itself by the day. We'll talk to you again, I'm sure, as the matters develop. That was Senyo Hosi, who is an energy sector analyst, formerly of the Chamber of Bulk Oil Distributors, speaking to us in the second part of the show. Earlier on, we spoke to the DG of the NCA, Edmond Irenchi-Fianco, on the outlook for the sector, 30 years of NCA. Thanks for watching tonight's edition of The Point of View.